Hey everyone, welcome back to Corporate Decoder, the place where we unpack that corporate jargon and find the juicy bits. And today we're diving into Leafbuyer Technologies Incorporated's latest financial report. Get ready because this one's got some interesting twists and turns that might make you say, whoa. So what is the big deal about this report? It is basically a snapshot of the company's performance for a specific period, and it gives us a glimpse into their financial health, their challenges, and their plans for the future. Think of it like a regular checkup for the company, and we're here to interpret the doctor's notes. Let's jump right into the numbers they're showing us right now. As of the 31st of December 2025, their total assets were just over $1 million. That might sound like a lot, but when you look at their liabilities, which are what they owe to others, that number is much higher. They owe over $2.5 million. This is a really important signal. We can see here that their total current liabilities, that means what they need to pay back within a year, stand at over $2 million. But then, when we look at their total assets, which is what they own, it is just over $1 million. This means they owe way more than they currently have. This is a pretty big red flag for any company, and it tells us they might be struggling to meet their short-term debts. And then there is the accumulated deficit. As of the 31st of December 2025, it was close to a whopping $25 million. This is the total of all the losses the company has had since it started. Minus any profits, it is like a running tally of how much money they've lost over time. Seeing such a large deficit definitely raises concerns about the company's long-term survival. Now let's look at how they made or lost money over a specific time. For the 3 months ending the 31st of December 2025, their revenue was about $962,000. That is a pretty significant drop compared to the same period in 2024, where they had over $1.7 million in revenue. That is almost a 43% decrease. Imagine losing almost half of your customers or sales in just 1 year. That is a tough hit. The company explains this revenue drop by talking about new regulations impacting their text marketing services. They mentioned that new rules from the Federal Communications Commission, or the FCC, and requirements for a mandatory age gate have changed how businesses can send text messages. This seems to have affected all companies in their industry. They're saying their customers are sending fewer messages or looking for other options. This is a clear example of how external factors, like government regulations, can seriously impact a business. Because their revenue went down, their gross profit also took a hit. For the same 3-month period, gross profit fell to about $445,000 in 2025, down from over $754,000 in 2024. That is a decrease of about 41%. Gross profit is what is left after you subtract the direct costs of making your product or providing your service. So, when this number shrinks, it means less money is available to cover other business expenses. On the flip side, their operating expenses have decreased. They spent about $511,000 on operating expenses in the last 3 months of 2025, compared to over $657,000 in 2024. That is a reduction of about 22%. They say this is mainly because of lower stock, base compensation for employees, and less in sales commissions, which makes sense when revenues are down. When sales are lower, you typically don't need to pay out as much in commissions. And if the company is tightening its belt, they might also be cutting back on stock options or other forms of compensation. And the bottom line for those 3 months in 2025, a net loss of about $80,000. This is a stark contrast to the net income of over $74,000 they reported in the same period in 2024. They've gone from making money to losing money. Let's look at the 6-month period ending the 31st of December 2025. Their revenue was just under $2 million, a big drop from over $3.3 million in 2024. That is a 42% decrease year over year. And for the first 6 months of 2025, they reported a net loss of about $124,000. This compares to a net income of over $86,000 in the same 6-month period of 2024. So, they've gone from profiting to losing money over this longer period as well. Now let's talk about cash for the 6 months ending the 31st of December 2025. Their operating activities used up about $129,000. That is a significant change from the same period in 2024, when they actually generated about $437,000 from operations. This means they are now spending more cash just to keep the basic business running than they are bringing in. They also used about $14,000 in financing activities in 2025, which is less than the $152,000 they used in 2024. This likely represents paying down some debts. This is where things get really critical. The company itself admits in the report that there is substantial doubt about our ability to continue as a going concern within 1 year. This is a very serious statement. It means that based on their current financial situation, there is a real possibility they might not be able to stay in business for the next year. They are relying heavily on raising more money through selling stock or getting loans to keep the lights on. As of the 31st of December 2025, their intangible assets, like software and things that have value but you can't touch, are listed as zero. However, just 6 months prior, in June 2025, they had over $143,000 in intangible assets. This means their intangible assets were essentially written off or fully amortized, meaning their value for accounting purposes has expired. They also have notes payable to related parties, which means they owe money to people connected to the company, like executives or early investors. For example, there is a loan from March 2020 for $600,000. Even though parts have been paid back, it seems like there is still accrued interest on some of these debts, which is being recorded as a liability. They say some of these loans were in default. Then there are the convertible notes payable. These are loans that can be turned into company stock. As of the 31st of December 2025, they had over $464,000 in these notes. A big chunk of these notes, over $182,000, is just accrued interest, and they note these were in default and payable on demand. This is a recurring theme in their debt section. When we look at stock options, it is interesting. For the 6 months ending the 31st of December 2025, they reported zero stock-based compensation expense. This is a big change from the same period in 2024, when they had over $37,000 in stock-based compensation. This might suggest they haven't granted many new options, or that the value of existing ones has declined significantly. And it looks like all their outstanding warrants, which are like options to buy stock, have expired. As of the 30th of June 2025 and the 31st of December 2025, they had no outstanding warrants. This means potential future dilution from these specific instruments is no longer a concern. But it also signifies that no new financing came through these avenues in the recent past. Now, let's talk about taxes, or more precisely, the lack of paying them right now. The company has significant deferred tax assets, mostly from net operating loss carryforwards, which are essentially losses from previous years that can reduce future tax bills. However, they've placed a full valuation allowance against these assets, meaning they do not expect to be able to use them to reduce future taxes. This is because they've had cumulative losses. Okay, so what is the company's management saying about all this? They're talking about expanding their products, going into new places, and really digging deeper into the market. They see the cannabis industry as a huge growth area, estimating it could be worth billions by 2028. They plan to grow by selling more and potentially buying other companies. But they also admit there is no guarantee. They'll find good companies to buy, or that any deals will be good for them. Looking at the numbers side by side for the 3-month period ending the 31st of December, 2025 versus 2024, revenues dropped by a hefty 43%. That is a pretty drastic decline. Cost of revenue also dropped by 46%, and gross profit saw a 41% decrease. Operating expenses, however, went down by a more modest 22%. This means that while they were spending less, they were bringing in significantly less money, leading to a swing from a profit of about $74,000 to a loss of about $80,000. Over the 6-month period, the story is similar, but perhaps more concerning. Revenues declined by 42%, cost of revenue dropped by 45%, and gross profit fell by 38%. Operating expenses decreased by 25%. The net result was a swing from a profit of about $86,000 in 2024 to a loss of about $124,000 in 2025. This section is all about how much cash they have and how they plan to get more. They openly state that their ability to keep going as a business depends on making profits in the future and getting enough money, either through selling stock or loans. They have cash on hand, but it is not enough to last them the next year. They are actively seeking more financing. It is good to see that they don't have any off-balance sheet arrangements. This means all their debts and obligations are clearly listed on their financial statements, which is what investors want to see. Finally, they mentioned that their disclosure controls and procedures were not effective as of the 30th of June 2025. This is a statement about how well they ensure that important information is properly recorded, processed, and reported. Essentially, they are saying their system for sharing financial information internally and externally needs improvement. However, they also state there were no changes in their internal control over financial reporting during the period that have materially affected it. So, my take on Leafbuyer Technologies Incorporated is that they're in a very challenging position. Their revenue has taken a significant hit, likely due to industry-wide regulatory changes. And they are operating with a substantial accumulated deficit and a working capital deficit. While they are trying to adapt and grow in the cannabis market, their ability to continue as a going concern is a major question mark. They are heavily reliant on securing additional financing, and the effectiveness of their disclosure controls needs improvement. The path forward looks tough, and they'll need to show a significant turnaround in revenue and profitability to overcome these challenges. What do you all think about Leafbuyer Technologies Incorporated's situation? Do you see a path to recovery, or is this a sign of tougher times ahead? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up, it really helps the channel, and be sure to subscribe for more deep dives into corporate finances. And don't forget to join our growing community on Discord, the link is in the description. Thanks for watching, and I'll see you in the next one.